The three most important words in investing are margin of safety. This is a quote from one of the world's most influential investors, Warren Buffett. As you may already know, the margin of safety is a common concept for any value investor. Even the big shot investors use this in their investing approach, and we definitely should too. However, a lot of rookies out there don't know how to calculate the intrinsic value of their investments, and they don't understand how to apply the principles of the margin safety. But don't worry, by the end of this video, you will gain all the skills needed to be able to do all of those. Hey, welcome to Stock Market Mate. Today we'll teach you how to calculate the intrinsic value of a stock. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. What is intrinsic value? Benjamin Graham and Warren Buffett are widely considered the forefathers of value investing, which is based on the intrinsic value method. Graham's book, The Intelligent Investor, laid the groundwork for Warren Buffett and the entire school of thought on the topic. The term intrinsic means the essential nature of something. Synonyms include innate, inherent, native, natural, deep-rooted, etc. Intrinsic value is basically a measure of what an asset is worth. This measure is arrived at by means of an objective calculation or complex financial method. Intrinsic value is different from the current market price of an asset. However, comparing it to the current price can give investors an idea of whether the asset is undervalued or overvalued. The financial analysis uses cash flow to determine the intrinsic or underlying value of a company or stock. In options pricing, intrinsic value is the difference between the strike price of the option and the current market price of the underlying asset. Why calculating intrinsic value is useful? The goal of value investing is to seek out stocks that are trading for less than their intrinsic value. There are several methods of evaluating a stock's intrinsic value, and two investors can form two completely different and equally valid opinions on the intrinsic value of the same stock. However, the general idea is to buy a stock for less than it's worth, and evaluating intrinsic value can help you do just that. Understanding intrinsic value. There is no one set way to calculate the intrinsic value of a company or stock. Financial analysts attempt to determine an asset's intrinsic value by using fundamental and technical analyses to gauge its actual financial performance. While they may build valuation models using qualitative, quantitative, and perceptual business factors, the metric often used in calculations for intrinsic value is discounted cash flows. Typically, investors try to use both qualitative and quantitative factors to measure the intrinsic value of a company, but investors should keep in mind that the result is only an estimate. Qualitative factors are such things as a business model, governance, and target markets, items specific to what the business does. Quantitative factors refer to financial performance and include financial ratios and financial statement analysis. Perceptual factors refer to investors' perceptions of the relative worth of an asset. They're largely accounted for by means of technical analysis. Generally speaking, intrinsic value can be considered to be how much the business is. Calculating the intrinsic value of a stock. To calculate the intrinsic value of a stock, you'll need two pieces of information. You need to know how much cash your stock is going to make in the future. Then you need to know what are those future cash flows worth to you, standing here today. To begin, the amount of cash that a stock makes for its owners is called the owner's earnings. To calculate this, you turn to the cash flow statement. You take the operating cash flow, then you subtract the maintenance capital expenditure. The operating cash flow, sometimes called cash flow from operating activities, is quite simply the amount of cash that the business operations of this particular company produced in that time period. The maintenance capital expenditure is quite simply the amount of money going out simply to maintain and keep the business in its current competitive position. The owner's earnings are the most accurate number to use for these calculations. However, some companies don't report their maintenance capital expenditure, and that can get pretty annoying. If this is the case, some investors opt to use total capital expenditure instead. This is basically the purchase of property, plant, and equipment on the cash flow statement. Intrinsic value formula. There are different variations of the intrinsic value formula, but the most standard approach is similar to the net present value formula, where NVP stands for net present value, FVJ is for net cash flow, and J is for the period of the initial present cash flow. J is equal to 0. I is the annual interest rate, and N is the number of periods included. Variations include multi-stage growth models and assigning a probability. Not every asset has cash flows, so not every asset has an intrinsic value. A good example is commodities, such as gold and silver. Because precious metals do not generate a stream of income, they have no intrinsic value, at least measured using DFC. By a similar analysis, cryptocurrencies have no intrinsic value. Some companies may be too difficult to estimate intrinsic value with any reasonable degree of confidence. Examples could include startups with no sales or no profits, as well as highly volatile companies in very competitive markets with an uncertain future. It's not that such companies lack intrinsic value, but rather that the intrinsic value cannot be estimated with any degree of confidence. Intrinsic value seeks to assess the worth of an asset based on future cash flows, not the current market value. As such, the intrinsic value of a company can vary, sometimes significantly, from a company's stock price. While it's not the only way to value a company, it's considered to be one of the fundamental approaches to securities analysis, particularly among value investors. Other forms of valuation. Intrinsic valuation is often used for long-term investment strategies, but there are many other approaches to valuation and investing. Alternatives include technical analysis, relative valuation, and cost approach. Number 1. Technical analysis. Technical analysis involves looking at charts and evaluating various indicators that may signal a stock is going to go up or down in the short to medium term. Examples include candlestick charts, momentum and moving averages, relative strength, and more. Number 2. Relative valuation. Relative valuation looks at what other investors are willing to pay for a similar investment and assumes that they would pay a comparable price for the company in question. The two most common examples of this are comparable company analysis, or comps, and precedent transaction analysis. Number 3. Cost approach. In the cost approach, an investor looks at what the cost to build or create something would be and assumes that is what it's worth. They may look at what it costs others to build a similar business and take into account how costs have changed since then: inflation, deflation, input costs, etc. Bottom line. Every valuation model ever developed by an economist or financial academic is subject to the risk and volatility that exist in the market, as well as the sheer irrationality of investors. Though calculating intrinsic value may not be a guaranteed way of mitigating all losses to your portfolio, it does provide a clear indication of a company's financial health. Value investors and others who prefer to select investments based on business fundamentals consider this indication a vital component for successfully picking stocks intended for long-term holdings. From their point of view, picking stocks with market prices below their intrinsic value can help save money when building a portfolio. Although a stock may be climbing in price one period, if it appears overvalued, it may be best to wait until the market brings it down to below its intrinsic value to realize a bargain. This not only saves you from deeper losses, but it also allows for wiggle room to allocate cash into other, more secure investing vehicles such as bonds and T-bills. That's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!